I guess one of the questions that we've raised here on the show as well, and I'd love to talk with you about is, are there scenarios where we really do see banking system risks, deeper solvency risks at the corporate and household level? And we can obviously distinguish between, emerging markets and developed markets in the United States. And even here, obviously in the United States, we know fundamentally it looks like the kind of reserve ratios have been strong, but there's also massive exposures in the form of these collateralized loan obligations, these so-called variable interest entities, kind of subprime corporate debt, and these commercial real estate bonds. A lot of these not even clearly on balance sheets. And if we do see structural unemployment and whack-a-mole kind of situation economically, do we start to see more turnover in defaults, whether it's in the corporate debt or broader sectors, and does that create deeper system-wide risks?
Jeremy, there are a lot of aspects of that. Very thoughtful question. I guess I would say this. Historically, we've had two patterns of economic downturn. We've had the kind of economic downturns that we had mostly between 1955 and the 1980s, in which inflation became a problem. The Federal Reserve hit the brakes hard. It wasn't able to fully control how it hit the brakes, and so the economy skidded into recession. But once the Fed took its foot off the brakes, then the economy tended to restore itself. That's been one pattern.
Right.
A second pattern is the pattern we saw most dramatically in 2008, but to some extent we saw in 2000 and in 1990, which is there was a period of substantial financial excess. The bubbles started bursting, deleveraging started happening, and you saw a bit of an economic implosion, more than a bit of an economic implosion in the case of 2008. In both those scenarios, you would expect the financial distress to lead the economic distress. Here, we're seeing something rather different, a substantial non-financial inhibition to economic activity. And so you'd expect the economic distress in some ways to lead the financial distress.
Right.
It can come from a number of forms. It can come from firms that are doing badly, losing the ability to meet their debt obligations. It can come from those with mortgage obligations stopping paying their mortgages. It can come from tenants not making their payments,
Right.
knowing that their landlords don't really have a viable option of evicting them, either because of the law or because if they did evict them, how would they get a new tenant in their place? Or it can come because of international cross-border issues where developing countries have difficulty repaying their debts. And so I think there are
all those together.
come from all of those together. So I think there are a variety of potential sources of financial concern. Frankly, I think that the markets would have imploded completely, and we likely would not have a solvent banking system today if the Fed had not acted to signal its commitment to backstop on a large scale. And I think as long as the government is prepared to stand by the financial system, it's pretty unlikely that you're going to have spiraling bank runs and the like. But I think we are moving to a substantially government-dependent financial system, which I think is likely to be what we're dealing with for quite some time to come. And that is close to being without precedent.